Welcome to the last lecture of our free beginners course. In the previous lecture, we talked about market maker indicators and levels. In the first lecture, we defined who the market makers are and reviewed their techniques they use to manipulate the charts. So in this lecture, we are going to talk about order blocks. Order blocks is actually something that is now very common on the charts and something that is being used by traders to acquire very high probability trades. So what are order blocks? I'm sure if you've been in trading for quite a long time, you've seen that many traders are now talking about this concept. So order block is considered a market behavior that indicates the pile up of orders from banks and institutions. The central banks and financial institutions mainly drive the forex market. So as we defined in the first lecture, that the market makers involve the central banks and large financial institutions. These are the people behind the movement of the markets. So the market tends to make a sharp move on either side once the order block is completed, right? What we mean is, if the market reaches an order block like this one, it will actually make a sharp rise away from that order block. So the key behind order blocks is that it includes what the giant institutions are doing. So how do order blocks arise on the charts? Market makers or large financial institutions need to trade wisely, otherwise they can also lose money to retail traders. So if they buy recklessly, we as retail traders can actually see that and take the trades in line right away. It's easy. So if they decide to buy or sell any particular asset with high volume that they use, they need to split their volumes. Buying all in will result in their contracts not filled. As we defined that the forex market is a zero-sum game. For you to earn money, someone has to lose money. And for you to be able to buy, someone has to sell to you. So if they do that with an amount, if actually they buy with an amount that is not corresponding to the sellers, it will result in their contracts left unfilled and will result in sharp spikes of price that can allow retail traders to enter the market. So this will affect negatively on their profit. To avoid this, they will split their positions. Say they want to ultimately buy 100,000 portion of Euro US, they can split it into two by 50k portions. So if they place their first chunk order, it will not create a sudden jump in price movements. So what we are saying here is, if they intend to buy Euro US, right, ultimately they want to buy 100,000 contracts of Euro US. If they go all in within the market, we've said their contracts, some of their contracts will not be filled since there will be not enough sellers for those contracts. So they need to split, say, into two, whereby they will have a 50k portion and another 50k portion. So if they place their first chunk, it will create a rise, but which is not sharp and obvious to everyone who is in the market. So let's say they put 50k here, the market will rise. Then they wait for more orders. If they do this, usually the market will actually accumulate orders as it will be going up. After having sufficient orders that can fill their ultimate goal of 100k, they participate in what we call cyclic trading. So cyclic trading is basically a way whereby Bank A buys and Bank B sells, right, like this. This is an effect. This actually affects on our market as an up-down move. So if they perform a cyclic trading, they actually can return the price back to their initial point. and then ultimately put in their second chunk of orders such that the market will leave off. So here's just an illustration of what will be happening. As you can see, the market is actually in an uptrend. Market maker A, or a banker from Dutch Bank or any big bank, wishes to buy into this asset. At this point, he places his first chunk, and the market goes up as a resultant of him participating in the markets. After reaching this point, he now needs the market to come back, since he has a goal to actually have double the first chunk that he has issued. Then, in this case, another bank sells to actually drive back the market to this first zone. That is where you will put the second chunk. After putting the second chunk, this bank that is sold will actually close off its position at its initial introduction of its contracts. And this bank B has done its job. So in these points or these zones whereby big guys or the smart money are actually introducing their contracts are the points that we call order blocks. So these order blocks occur over and over again. However, you need to know or understand the market context for you to actually understand how these are actually used. So how do we draw an order block on our charts? For drawing on an order block, simply mark the high of a price rally and draw a rectangle around it. So what we call a price rally is basically a point where the market was actually moving in a sharp manner, right? If we see a sharp move, we actually know that there were market makers involved within that move. So this low is probably the point where they actually introduced their contracts. So we simply mark the price, the low or high of a price rally, depending on its context. If it's an upward move, we know that at this point, that is where they introduced their positions. If it's a downward move like this, we know that at this point, that is where they also introduced their positions. However, there are candlesticks that you need to look for in these zones. We talk about this in the advanced course. So we'll then extend the rectangle to the right into an empty area of the chart where price will act or react in the future. So we'll then protrude into the future and anticipate that the market will actually come like this. However, as I have said earlier, you need to use these order blocks in line with the market maker context. Using them without the context will actually result in you using order blocks that are not refined. So, how to use order blocks? To use order blocks, as I've said, needs some other supporting concepts that we haven't talked about in this free course. Details. On that note, we have come to the end of our free course